Good morning everyone, we're really happy to welcome here today on our third webinar regarding VAT, Brexit and Customs. My name is Axel, I'm a European VAT consultant at Easytax, and I will be with Nicola Dasta and Daniel Jecker in the chat later on. Today's webinar is going to be focusing on the Brexit and the impacts it will have when the UK will be out of the EU. We won't be discussing how and when this will happen, but rather how it will work when it's done. Therefore, you will be ready for the Brexit. Before we start, I'd like to give you a bit of background information on Easytax that has three main activities. The first one is the submission of Intrastat returns across the EU. The second one is a service of fiscal representation across the EU, but also in some non-EU countries like Switzerland. And the third one is training sessions in fiscal areas, including VAT and customs. Our main clients are either companies involved in the imports and exports, or also accounting firms. To do that, we'll be looking at what are the impacts, how to minimize them, and we'll conclude with solutions that could help you tackling such changes. Before we start, just a bit of introduction. As we're all aware, today the UK is part of the EU. Therefore, when we're talking about trading with the UK, we're talking about intra-EU acquisition and dispatches. That won't be the case anymore, as tomorrow the UK will be out of the EU, therefore we will be talking about import and export. To ease this change, the UK wants to negotiate a free trade agreement to benefit from the same status as EFTA countries. The aim of this is to either reduce or remove customs duties. Nothing has been agreed so far, but it's a good way to understand the goal the UK wishes to reach. It's really important to understand that customs duties can vary from 0 to 15%, which could have a significant impact on the goods value. It's also important to say that, however, that even though an agreement could be reached, not all the products will be covered. So now let's move on to the changes by starting with customs aspects. We will be looking at imports first. Each and single parcels will have to be cleared before entering the EU from the UK. On top of a custom clearance, there is a need to pay import VAT and any other taxes related to the import of products. When we're talking about taxes, we are referring to excise duties or parafiscal charges in the clothing industry, for instance. Now let's move on to export. As import, every parcel will have to be cleared before exiting the UK. There is a change that is going to impact all of you with the modification of the proof of exemptions. Before, you used to be looking at the transport document, also called the CMR, when we're talking about road transport. The proof you are going to be willing to conserve will be a customs document, also called the single administrative document. As a reminder, the SAD must have the right ECS status to confirm that goods left the territory. Now let's move on to obligation. It will be mandatory to have a URI number. Before the Brexit, a company only needed one across the EU, but after the Brexit, and as the UK will no longer be a member state, a second one will be required. Now, talking about formalities, on top of the regular formalities we just discussed, and depending on the products you might be willing to import, you might have some extra obligations to handle. We could be talking here about either dual-use goods for both civil and military purposes. We could be talking about CE markings for electrical toys or goods. We could also be talking about products subject to CITES requirements. And we're here talking about a convention preserving endangered species. So as you can imagine, the regular process will be already pretty time consuming. But on top of that, you might also have to consider other controls We're talking here about physical controls of both goods and documents. That could lead to serious delays in your delivery schedule. We're also talking about sanitary checks. The important point here is to make sure to import at a location that is fully equipped to handle such controls. To grasp a better understanding of what a hard Brexit means, here are a few figures. In terms of budget, we're expecting between 300 to 450 million pounds. As you can see on the slide, there is an impressive increase in the number of customs documents to submit. There is also the chief executive of HMRC also announced between 3,000 to 5,000 new employees to cope with new customs obligations. Now let's move on to another principle that will be affected by the Brexit. Back in the days, the EU negotiated bilateral agreements with third countries to reduce or remove custom duties. This is linked to what we call the concept of origin. If we take two examples, we will have UK companies that are manufacturing goods in the UK that might lose their Made in the EU label. But on the other hand, we will have components coming from the UK that are included in the manufacturing process of goods in the EU that might also lose their EU label. To illustrate that point, let's have a look at the following slides. This example is before Brexit. A company was shipping skirts from the UK to France, but was also adding laces onto the skirt before exporting the end product to Morocco. As all the components were EU-based, the product could benefit from the Made in the EU origin. What was the impact? No customs duties in Morocco to pay thanks to bilateral agreements. So now let's have a look at the same example but after Brexit. What will change here is that obviously the skirts will be still coming from the UK that will be considered as a third country. So the question is, can a company still benefit from the EU origin even though components came from the UK? To answer this question, it's necessary to check whether the level of transformation of the skirts matches the EU origin criteria. The answer is no, because the origin criteria highlights that it's essential to either manufacturing from sewing threads or from fabrics, which is not the case here. It has a significant impact because rather than paying 0% of customs duties, the same company with the same product will now pay 25% of customs duties. As you can imagine, there is a loss of competitiveness for such companies, and also it highlights the fact that the UK will have to negotiate agreements on its own to lower the impact of Brexit. So now that we've discussed customs impacts, let's move on to VAT impacts. As we mentioned earlier, an intra-EU acquisition will become an import. Therefore, import VAT must be paid. It has an impact on cash flow management, even though the UK is talking about introducing a postponement of accounting of import VAT to lower the burden. Moving on to distance sales. A UK company was able to trade with the EU without having to register until annual thresholds were reached. This simplification will no longer apply. A UK company will have to register for VAT in the EU, probably through a fiscal representative to keep delivering DDP to EU consumers. Moving on to digital service. Back in 2015, the legislation changed. A UK company supplying digital services to EU consumers had to charge VAT where the customer is located. To avoid having to register in potentially all the member states, an EU VAT MOS portal was launched. However, as the UK will be out of the UK, will be out of the EU, this portal will no longer be available. Talking about EU VAT refunds now, as any other EU countries, the UK was able to benefit from the EU VAT refund portal to reclaim VAT on expenses incurred in the EU. Once again, this process will no longer be available To reclaim VAT, a UK company might have to appoint a fiscal representative established in a targeted country. We're also going to keep focusing on changes that will happen post-Brexit here. First of all, the B2B general rule for supplies of services is that the supply is made where the customer belongs. Where this rule applies, a UK company must gather commercial evidence showing that the customer is an active VAT-registered entity that belongs outside the UK. Before Brexit, a VAT registration number was the best evidence you could retain to prove this. After Brexit, and even though the UK is not planning on amending such VAT rules, you might have to consider alternative proofs to be able to prove the status. This includes certificates from fiscal authorities or other commercial documents indicating the nature of the customers in its home country. Talking about EU VAT registrations, when a UK company needed a VAT number in the EU for whatever reason that might be, it had the choice to either register directly or through a tax advisor. If the UK faces the same situation post-Brexit, chances are it will have to appoint a fiscal representative that becomes jointly and severally responsible. The impact could be higher fees for such services. Talking about the VAT margin scheme, to illustrate this change, let's take the following example. We have a UK car dealership selling second-hand vehicles to a French company. Before the Brexit, the French company applied VAT on margin only. After Brexit, the car will have to be imported into France with payment of import VAT, and the French company will have to charge VAT on the total value of the car. As you can imagine, there is also a loss of competitiveness, as the French company might want to stick to EU suppliers to keep applying the VAT margin scheme. As you can see, significant amount of changes to expect. You might also want to check the following areas. Cost price. There will be an increase with customs duties and the cost of formalities as well. Talking about cash flow, you have to take into consideration that import VAT must be paid unless you adapt quickly enough. When we talk about quickly enough, we want to refer to the potential reverse charge on import scheme. You also have to get familiar with incoterms that were probably not controlled thoroughly enough in your EU flows, but it will reach a whole new level when dealing with imports and exports. As a reminder, it defines terms of an international transaction with both buyers and sellers' obligations. You might also want to review your commercial contract to include the points we just discussed. Now that we've looked at the impacts coming from the Brexit, we can move on to the next point to analyse how these impacts can be reduced and what solutions can be adopted to lower hassles from these changes. So let's see what we have here with solution number one, which would be selling DDP in France, in the EU or in the EU. So what does it entail? The UK company will have to register for France through a fiscal representative. So what are the advantages? Well, first of all, you will be able to handle all of your imports procedure internally. That means a better control of them. You will also be able to deliver French clients DDP, so the client does not have to handle extra obligations. This solution can also be improved with the following solution that is highlighted in the next slide. So we have the same situation here. However, the UK company opted for the reverse charge mechanism on imports in France. So as we said before, and on top of handling customs procedure internally, you will be able to benefit from this scheme that was introduced back in 2016. The advantages are clear cash flow management, where import VAT won't have to be paid anymore, and it's also a good way to ease the transaction with your local clients. There are 4 conditions to meet to be able to register for the scheme. First of all, you have to be VAT registered in France. Second of all, you must handle imports transactions through a customs representative that has the AEO certification. You also need to have an ERP software that allows you to manage customs, tax filing, and also fully track your imports. And you need to have a clean slate in terms of serious or repeated breaches in terms of customs and tax rules. So here you can see a screenshot of the actual document that is necessary to fill in to register for the scheme. When talking about reverse charging import VAT, it's extremely important to focus on the taxable base that must be reported on your VAT return. So what should it be? Do not use the footer value of the import invoice. As you can see here, some items might have to be added on the initial value, such as royalties, value of the tools and molds used in the manufacturing process of the imported goods. We are going to talk about a third solution here, that would be to start importing through another member state to implement what we call the onward supply relief or the 42 customs regime. The idea behind this flow would be to leave the UK and go through, let's say, Belgium or the Netherlands as a matter of fact, and you will also be able to reach France or all of your EU clients in Germany or in Spain, like the chart here. So how can this be done? You will have to appoint a limited fiscal representative to clear the goods in Belgium. Only duties will have to be paid. Rather than declaring an import in Belgium, you will be able to declare a dispatch from Belgium to your end customer's country, who will declare an acquisition from Belgium. All of this without paying a dime of import VAT. So what are the advantages? It is a pretty straightforward process in some countries. There is no cash flow, and it could be a good point of entry to the whole EU market. A fourth solution here could be to set up a storage facility in France to deliver either local or EU clients. We will have all of the EU clients on the next slide. This solution would only require one VAT number in the country of storage and allows you to deliver your client's DDP exactly before Brexit, handle customs procedure on your side not to burden your clients, and also to guarantee delivery as goods will be stored in the EU in free circulation. So now this slide highlights the fact that you can store your goods in France and deliver your EU clients as well as your local ones. Rather than treating the transaction as an intra-EC acquisition from the UK to clients based in Germany, the client will treat it as an acquisition from France to Germany, and you will treat it as a dispatch from France to your client's location. We are going to move on to another solution, which is quite different from the previous one we discussed, because all the flows were from the UK to the EU, and this one is the opposite, as we will be talking from the EU to the UK. So it could be an idea to give to your EU suppliers to shift the VAT burden to them rather than supporting it yourself. The arguments are pretty similar to the one we discussed, as you could request to be delivered DDP. So now, how can we help you? We are a team of experts providing fiscal representation services across the EU and on other non-EU countries like Switzerland. We are all aware that VAT compliance can be tricky, therefore our aim is to make it easy. How are we going to be able to handle this? We are 10 dedicated consultants that will analyze your flows to highlight obligations to comply with local VAT laws. Technical data are provided to understand and comply with obligations per country. We're talking here about invoice requirements and all that kind of things. And we also monitor your expansion on a monthly basis by forwarding data of your transaction declared in each member state. On top of flows already discussed, here are some activities that could trigger VAT obligation in the EU. If you happen to carry out such transaction, the best would be to check whether or not you have VAT obligation in the EU. We also have a service specialized in the analysis of VAT and customs regulation. This could be helpful if you want to either register your company as an authorized exporter or a registered exporter, to benefit from the reverse charge on imports in France, and also to make sure to certify your EU origin. This is it for today, people. We were very happy to discuss all the Brexit issues with you, and we hope that it gave you some useful information on how to handle things in the future. We are about to answer all of your questions, so in the meantime, if you could take a few minutes to complete our satisfactory survey, that would be really good. I really want to thank you for your attention, and I will see you on our next webinar. Thank you.